Everyone wants to know how to manage a short option contract when price puts it in the money. So today, I will showing rolling options in a replay on NVIDIA back in COVID days, which will enable me to get the puts in big trouble and deep in the money. I will open the PassiveNomads.com option simulator and load the NVIDIA chart. This free options simulator is super easy to use and it has no affiliation to a broker, so it's hassle-free. I can test all my strategies and ideas on this platform over a coffee. IV at the money, displayed at the top of the screen here, is relatively low, which means the options are not carrying much premium for me to sell, due to the market not having any volatility in it at this point in time. I sell a naked put. I will try get these in trouble, so I will just go around a 0.3 delta out of the money put. Price rallies, and so far the naked put is just putting money in the pocket. I will try this again, same delta strike, next month contract. Again, price rallies. As you can see, selling puts can be easy majority of the time. It is just when the market turns, which happens each year nowadays, that this becomes a scary scenario. Eventually, the market consolidates, and my strike becomes slightly underwater. What is happening here is the red P&L does on anyone's position does not actually reflect how an option seller is profiting right now. Options work like this. Let me use an analogy. When an option contract is in the money, think of it like a glass is filling up with water. The glass is the option contract, and the more the price goes past its sold option strike, the glass is filling up with more water. This water coming into the glass is what is called intrinsic value and only goes away when price drops back outside the strike price, which would mean the glass will empty, no water due to no intrinsic value. Now to see how extrinsic value the premium A option seller makes his profit, imagine this same glass first has a tablespoon of oil in it. This oil in the glass will represent the extrinsic value. If that glass takes on water, or what we call intrinsic value, the oil stays on top even as the glass becomes more full. As time passes, days or weeks continue, the oil slowly evaporates no matter if there's water in the glass or if the glass is empty. If we like oil and option sellers love oil, we have the unique ability to swap out glass with hardly any oil remaining for a new glass with lots of oil. This is called rolling. Back to the simulator, our position took on a little bit of intrinsic value, and with little days remaining in this contract, so I will roll this option for a new option with a month till expiration. The IV has also increased, so I will get a bit better premium or extrinsic value in my pocket for swapping my old contract for the new contract. Now, the market is showing some major volatility and price drops. This is the scary scenario every new trader fears. Price bounces, and I will make another roll here due to current option having little extrinsic value remaining, with what could be a last chance to catch a good premium on a roll before price drops too far away, and I start playing a slow rolling game. Price is bouncing a lot, and I get another chance to make a roll with price close to my strike. Great timing as my strike is ready to roll. I can't say it is going to be so to script for long. I make the new roll, I reload my premium, and continue. The market drops again, and close to the end of this current contract expiration, I have to roll. I will check the further away contracts to see if I can get better premium. Sometimes the IV is skewed to be paying good premium in further away months, called back months, due to the market pricing and volatility up to that point or beyond. I do something else here. I want to make some more money, and IV is elevated, so I sell a call leg also. I will harvest a call side premium now that the put side is in a harvest game. This call leg I take up fast though. The IV dropped on the stock. I will take it as a small short trade and go back to harvesting the put leg. I drop the strike from the put side to a lower strike to capture some extra premium now. This position is getting very deep in the money. This is called rolling out and down. I'm on full defensive here, trying to harvest the most premium I can. Rolling down carries risk because I know I'm risking the market rebounding back past my put strike. My plan will be to buy 100 shares when price is above this upper resistance level. The market did recover. I have my shares, so my put leg is covered for any remaining intrinsic value the current leg was missing from rolling down. And now, with the price rallying, I have shares to sell a call against when ready. As you can see, the good companies in the markets recover from their bear market times. You won't become a rich man, but you will be able to premium harvest if any money in your portfolio is bagged in a naked position on the put side. If you want to practice something like we did today, jump over to PassiveNomads.com and try it out yourself. This is the best free option simulator online. Replay 5 years of history for SPY, Tesla, NVIDIA, Rio Tinto, and see how strategies play out and how to defend them during the COVID crash. You can also practice 0 DTE options on SPX. Passive Nomads Option Simulator, replay over coffee.